And now we come to our first panel discussion entitled The EU Financial System Amidst New Threats. The panel will be chaired by Governor Olli Rehn of Suomen Pankki and ESRB First Vice Chair. Governor Rehn will introduce the panelists and lead the discussion. Over to you, Mr. Rehn.
Thank you, Connie. Good morning, everyone, and warmly welcome to this panel of distinguished experts. We know that the EU financial system is challenged by a range of emerging threats, many of which originate outside the system itself. Following the excellent, insightful and thoughtful speeches and keynotes and responses this morning, our panel will explore some of these key challenges, including the evolving geopolitical landscape, including the new economic geography, as Adam put it, as well as the non-bank financial spectrum and cyber challenges, as well as stablecoins, cryptos. We'll discuss also policy responses. Let me start with the introduction of the four panelists, brief introductions. I start with, against the protocol, I start from a gentleman this time. So Marko Buti holds the Tommaso Padova-Schioppa Chair at the Robert Schuman Center, the European University Institute. Marko has previously served as Chief of Staff to Commissioner Paolo Gentiloni and of course as Director General for ECFIN, or Economic and Financial Affairs at the European Commission, from 2008 to 2019. Not the easiest of times, and we worked very closely with Marko during the Eurozone crisis. Marko is also a graduate of Universities of Firenze or Florence and Oxford, and a senior fellow at Bruegel and member of SEPRA Research Policy Network. Ian Goldin is the Oxford University Professor of Globalization and Development and the founding director of the Oxford Martin School, which is a leading center for interdisciplinary research into global challenges, where he started 45 programs with over 400 academics. Ian was previously World Bank Vice President and the group's Director of Policy. Prior to that, he was Chief Executive of the Development Bank of Southern Africa and Economic Advisor to President Nelson Mandela. Then we have Dr. Cornelia Holthausen. Cornelia is Director General for Macroprudential Policy and Financial Stability at the ECB, responsible for providing policy advice on macroprudential policies, financial stability, financial regulation, including stress testing exercises. And it's also worth mentioning she chairs the Eurosystem's Financial Stability Committee and is member of the Basel Committee. Then I turn, last but not least, to Loriana Pelizzon. Loriana is Vice Chair of the ESRB Advisory Scientific Committee and Professor at the Goethe University of Frankfurt. She is also Deputy Scientific Director, Head of Financial Market Department and Coordinator of Gender Equality at the Leibniz Institute for Financial Research, SAFE, as well as a research affiliate of MIT Sloan, SEPRA, and Professor at Ca' Foscari University of Venice. So, dear friends, it's a real pleasure to open this panel entitled The EU Financial System Amidst New Threats. And let me underline that these threats are not abstract from geopolitics to cybersecurity. They are already shaping our markets, our institutions, and perhaps even the foundations of the financial system itself. Not long ago, political uncertainty in the US pushed treasury yields sharply higher, liquidity thinned, and we in Europe felt the spillovers almost instantly through exchange rates, capital flows, and market sentiment. And this demonstrates how tightly connected our financial systems are. And now with financial innovation, the picture is even more complex. Stablecoins are boosted by the US administration. They could link crypto markets more directly to regulated banking system, raising interconnection and new contagion risks also for Europe. The second area we will discuss is digitalization and, of course, AI, artificial intelligence, which provides new tools for analysis of financial stability, but also creates new vulnerabilities. And the third area is cyber and geopolitics. Cyber risks are no longer isolated incidents. They are constant. In today's very tense geopolitical environment, they are indeed more dangerous, less predictable, and potentially systemic. And that's why operational resilience has become a global priority, which cannot be managed by any one country alone. It calls for coordination and European cooperation. So let me put out the opening question for the panelists, to which you respond in your opening remarks. What do you see as the most important sources of systemic risk especially over the longer term, and why should the ESRB prioritize them? With that, let me now turn to the panelists and invite them to share their perspectives. And I will start with Marco Buti. So Marco, please, the floor is yours.
Okay, thank you very much, Olli. Nice to be here and remember indeed the old times, difficult times now, but there were difficult times at the end at that time as well. So what I have tried to do is this one slide. This is a tour de force because I have tried to collapse 90 years in one slide. So I'm stretching Adam back and forth. Now, 8 years since Bretton Woods, and I mean that's the mandate for our panel, 10 years ahead, and I've tried to decide to do that by taking, let's say, the two dimensions. Okay, one is free trade, and the other one is free capital mobility, and you see the history playing through the various arrows there. Now, admittedly, one has to cut many corners in doing so, especially in the first quadrant here, which is the longest one. There, you know that they have, one can elaborate, there are sub-periods, there is a Nixon shock at the beginning of the 70s, but, by and large, I've called this in the Bretton Woods shadow. So in spite of the turning points within the period, an element of multilateral cooperation actually prevailed in any case, even in difficult times, even under unilateral cooperation. It was a period in which you had progressively liberalization of free trade, but no full capital mobility. We moved then from the 1990s to, I put here, mid to 2010, so 2016, in a yes environment, which is, hyper-globalization, where Washington, but I would say also Frankfurt, Brussels consensus actually prevailed, and with this was a period of markets being unleashed. Then we move horizontally towards a situation in which you still had free capital mobility, but a progressive erosion of free trade. Here it starts with the first Trump administration, but actually Biden did not reverse that. So I put this together till 2024, 2025, where there is a return of industrial policy and actually also as a response to the various crises, including the COVID crisis, the energy crisis related to war, actually governments have the upper hand. Now, my claim here, and maybe test it for the audience also, is that that quadrant there is not a stable equilibrium. It is an equilibrium, but not a stable one. So it means we have to somehow from there move to other quadrants to find a more stable equilibrium. So where are we going to move? In a normative sense, I would know where to move, but on a positive dimension, what is the likelihood of moving from that quadrant? I think difficult to believe that we would move back to the hyper-globalization situation, so back horizontally to the left. I think difficult also to believe that one would move back to the multilateral cooperation the way we knew it. So I am afraid that I attribute a higher probability to move up, where we end up into a sui generis pre-Bretton Woods system in which you have no free trade and also no free capital mobility. In this situation here, and you would see it on a daily basis, big actors, private with private-public dominate, and there is across-the-board weaponization of on everything we know about. So I think the scene for that, for assessing new risks for the financial system and from the global system as well as the European one, is probably to take as a central scenario to move upwards into the no-no scenario.
Thank you very much, Marco. Much food for thought. I would be tempted to pose a follow-up question, but we go first and we continue with introductory remarks, and we follow the original order, and it's Professor Ian Goldin next. The floor is yours, Ian.
Thank you very much, Chair. I've been asked to focus on the non-economic risks, and the first thing I think to stress is that systemic risk breeds systemic risk. We're in a spiral where this will continue. This is not related simply to the Trump presidency. It will not go away in a few years' time. This is the butterfly defect of globalization, contagion and spreading. It will intensify, and partly because of this endogenous element to it. We would not have had, I think, Brexit in Britain or President Trump 1.0 in the White House had it not been for the financial crisis. These are multiplicative crises, negative spirals, but technological climate and other threats are racing ahead of our capacity to manage them, and of course that reinforces fragmentation, nationalism and protectionism. The concentration effects of the knowledge economy and AI also exacerbate this because they lead to more inequality both in income and in space, geographical space. Our democratic systems in Europe and North America, which is why we are so different to the rest of the world, Australia, obviously Canada is similar, are representation by place. That's in sharp contrast to the economic trajectory, which is concentration of income, jobs, and livelihoods by place. So we have to get beyond the Industrial Revolution, spread of geography, to a new system, and the democracy does not allow that as we know it. The key international institutions, WHO, WTO, UN, are less fit for purpose than they were, and they will become increasingly so. This is also true, unfortunately, of the IMF and World Bank as well. And so the risk prevention system is much worse than it was. The likelihood of a pandemic is much greater today than it was in 2019, and we don't have the wherewithal to manage it like we had in 2019. And of course, in the US, the aversion to vaccines will increase the difficulties associated with that. So too are climate shocks and the potential for military conflicts, and on the economic space, others I'm sure will talk about cyber and other risks. The rising military expenditure, aging pressures on pension and health expenditures, growing dominance of elderly voters, and the other dimensions related to climate, pandemic, and so on, undermine fiscal and monetary stability, and so does, of course, the politicization of interest rates. The bandwidth of politicians is not expanding. They cannot juggle more than 2 balls at a time generally, and as the number of risks multiplies, as the complexities multiply, the mismatch between leadership capabilities and management are also mounting. The mounting debt and questions of US dollar are being dealt with by others, but this all brings back, I think, the role of the ESRB, the importance of the ECB, the importance of Euro and Europe, as Adam has stressed, but also, and this is perhaps where I have a slightly different interpretation to Mario, I think Asia is a source of stability. I think trade, capital flows and others will grow, that globalization is alive and well. It's living in Asia. Thank you.
Thank you very much, Ian. Next we move to Cornelia Holthausen. So Cornelia, please, the floor is yours.
Thank you very much, Olli. So I will focus on the evolution of private markets and stable coins, and to say a few words on the risks that are emerging from these trends. So private markets, obviously the way of financing, providing financing to companies directly through private equity or private credit, not necessarily through the banking sector. And you see here on the slide the rapid growth that we have seen in this sector across the world. So if you focus on the left-hand side, that's in relation to private equity. You see that across the world, this sector has been growing, but of course much faster in the US on the very left than in other areas of the world. But even in the Euro area, I mean, on a much smaller scale, but it's undoubtedly that this sector is rising really very fast. And on the right, you see similar developments on the private credit side, admittedly quite still at a low level, but still in the Euro area, we see that 700 billion euro of assets are under management in these entities, and that's a large increase compared to the 500 billion that we had still back in 2020. So I would say that's a very welcome development. Finally, I mean, the European Union is maybe a bit behind in this development. We, of course, are traditionally a bank-based economy, so it's good that there are alternative sources of financing for firms through capital markets. And we have a nice paper in our financial stability review in the last edition by my colleagues Katharina Serra, Oskar Schwarz, and Alessandro Ferrante, who show some of the benefits of having private financing through private markets. And in particular, there's a positive effect because it's the more riskier firms, it's the younger firms that are able to achieve this type of financing. And apparently, private market and private finance providers are better incentivized to provide financing to these firms that are riskier, but also have a higher upside, in particular if you think about a private equity financing. So that this is a benefit over banks. And another aspect is that banks typically rely on collateral when they provide financing. Again, younger firms, more riskier firms, they may not yet be able in a situation to provide this type of collateral. And then last but not least, banks will also, they shy away from having too risky investments. So private capital is therefore a very nice alternative to bank funding. And we, in this paper that I just mentioned, they show very nicely how also the pure fact that there is investment from the private sector also really leads to more long-term investments and had other positive benefits. So now let me come to the risks. So this is all very nice, but as Madame Lagarde said this morning, so the risks are there. They are just channeled through different intermediaries. So we have to monitor these risks. One aspect is that these private capital entities are often very highly leveraged, so they're vulnerable to downturns, they're vulnerable to any adverse events that may occur. From our perspective, it's also an issue that these are very opaque firms. We don't have a good database for them. We don't know enough about them, and we don't know in particular the risks that come from this sector and how it would propagate to the banking sector of side that we are much more capable of analyzing, but these interlinkages, they are difficult to see. So, and there are really multiple relationships between the private lenders and the banks. So for instance, because private banks invest in them, so they give lending to these vehicles. They often partner up when they provide financing to the economy, and also, and after all, they have common exposures. They do invest in similar entities to some parts. So these are risks that we would like to understand better and that we are working on. And then let me mention one final aspect, and that is that the valuation of the projects that these entities invest in is often a bit backward looking because they use mark-to-model valuation, so it's not updated on a regular basis. I was also going to say a bit about crypto and stable coins. So these entities are also, and you see it on this slide, of course, growing at amazing speed, and this maybe complements a bit Madame Lagarde's words from this morning. So on the left-hand side, you see the rise in the total market capitalization of crypto assets. At the very bottom, the blue line is the stable coins. So it's relatively small, of course, at this point in time, but you do see that it's growing, and we do know that there's a political push in some areas of the world to promote stable coins more, and also, of course, crypto assets more in general. So it is something I think that we should be aware of, that we should monitor very closely and to understand what it means. Again, same type of risks that are in the economy will also affect stable coins. So it's important to look here. And it has implications not only on financial stability, it also has implications on the whole payment sphere. And I think Thorsten alluded to it this morning. There is the potential for a lot of competition between stablecoins, the credit cards, traditional bank-based financing, or when we have it, the digital euro, for instance. So I think this whole payment landscape is going to be shaken up and then look potentially very different. And then finally, we have the issue of monetary sovereignty. That is also, I think, something that central banks should look very closely at. And then my final point is the multi-issuer schemes that President Lagarde mentioned this morning. But I don't want to go into details here because she explained it very well.
Thank you very much, Cornelia. And we will certainly return to stablecoins and cryptos in the course of this panel. And I will have a follow-up question to you. You can reflect now already while Loriana is speaking concerning, you could perhaps distinguish between cryptos in general and stablecoins in particular from the standpoint of systemic risk to financial stability. How do they differ in this regard? And would the stable coins, if they truly grow, would they, as they are narrow banking essentially, would they affect credit creation? Mm-hmm. Two easy questions for you, so you can prepare. Next, Loriana, the floor is yours, please.
So thank you very much for inviting me. And we are discussing a lot about non-bank financial institutions, the risks that are behind these non-bank financial institutions. Well, at the Sintra ECB Central Bank Forum, I was indeed producing some analysis about the non-bank financial institution in Europe, and this graph is well representing through time from the 2000s on one side over GDP in Europe. You can see that banks, the light blue, are in some sense remaining quite stable, are just 2 times the GDP. But if we are looking to all the other institutions that we are calling non-bank financial institutions, like insurance, pension funds, investment funds, and also the orange one, that is the dark orange, that are these other financial institutions, you see they are continually to increase, and they are reaching now, they were having a peak a few years ago of 8 times the GDP, and now they are 7 times the GDP. So this means that really this sector, where we don't have enough data and we don't understand very well what they are doing, in Europe are growing a lot. And if we are comparing this path with the one that we observe in the US, the next slide, we can see that, can you please move to the next slide? Okay, we can see that in the US, clearly it started to grow quite a lot in the past, but now it is largely stable and is just 5 times the total financial system over GDP in the US. It doesn't mean that in nominal times is smaller than the one in Europe, it is larger, but in terms of GDP is 5 times lower, is 2 times lower than the one in the US. And this was also mentioned before by President Lagarde. And clearly, first of all, this is surprising. Second, we need to understand better what does it mean having a very large, potentially, with respect to GDP, non-bank financial sector. And if we move to the next slide, we can really see that if we are comparing properly, not in terms of, so taking out the banking sector, that clearly in Europe is larger than the one in the US, you can see that pretty much in 2015-16, the amount of, let's say, of non-bank financial institution over GDP in Europe do start to be larger than the one in the US. But clearly, this is opening up a lot of questions. The first is, where are these institutions investing? Are they really helping the real economy, for example? And if you are looking to where these non-bank financial institutions are investing, more than 50% is invested abroad. So more than 50% of the total asset of these companies are largely investing actually in the US. So this is one thing. So they're not really, as in the US, supporting a lot the lending to non-bank, non-corporate financial institution. And for example, this is true here. We have now starting to have some private credit, but for sure it's far lower than the one that we observe. And the large fraction, as I said, is going abroad. So on one side is a missed opportunities. If you are thinking to all the debate that we have in the previous section, well, we are now saying that Europe will attract a lot of, let's say, investment. Well, the question is, are we maybe also able to keep a significant fraction of the investment that actually is going abroad? That from the investment perspective is perfectly fine. If you're thinking that we believe on the market portfolio, if you're looking to the market portfolio, more than 50% is US. So if you're following the simple rule of diversification, you should invest 50% in the US. Are we going to change this way to do our investment? And then clearly the question we need to ask is, why do we have all this growth? And why do we have this type of pattern that is different than the one in the US? And the reason, I'm sure, I can tell you a few of them, but I'm sure that if I'm asking to each of you, you will have your own story. One is that GDP in Europe is lower, is growing less than in the US, so it's a problem of the denominator. On the other side, in Europe, we are saving far more. So this is why, then we are investing a lot abroad. Another possibility is that these savings are largely managed by company where the headquarters is in the US. And therefore, even if, formally, this type of institution are in Luxembourg, actually they are managed by US, let's say, investor. And then the fact that actually our capital market is so small that all this investment cannot go to, less than 1,000 firms. So clearly, if we have a non-bank financial sector that is growing so much, they need to find a way to invest in our capital market. But if our capital market is so small and fragmented, of course they're going to invest abroad. So on top of all the risk that clearly we need to start to investigate, we need also to think on how to improve the use of this large sector. Thank you very much.
Thank you very much, Loriana. And now we move to the comment phase, and all of the panelists have a few minutes, and they can respond to the question of what policies should the authorities adopt, what kind of policy tools, competencies introduce in order to prevent and mitigate these systemic risks. And I also give you the chance to comment Adam's and Thorsten's presentation. If you so wish, you can choose, and then we move on towards questions from the audience. But first to Marco, and I have a special question for Marco, knowing your strong macroeconomic background. In Adam's presentation, we heard that the ECB should prepare for a larger role as a global reserve currency, the famous discussion on the international role of the euro, and that will imply or is likely to imply capital inflows from, say, emerging and developing economies to Europe. Are we sufficiently prepared for that? What should we do in order to be better prepared for that?
Okay, thank you very much. Let me take this immediately. And now Adam may correct me, but if I remember well his slide, you said we should not fear the potential appreciation of the euro that would come from that. I think that is fully right, actually. It goes hand in hand with the reorientation of our growth model from something which is essentially driven by export from sources of growth which are more indigenous. So I think from that viewpoint, the two are not, they are not contradictory. Actually, they strengthen each other. But obviously, what we need to do also on the international role of the euro is to list the various elements which are needed in order to buttress that type of role. And I think at the end of the day, first of all, dispelling the inherent risks that we have still on the solidity of the eurozone, and second, embracing safe asset and increased supply of safe assets. I think these are conditions sine qua non in order to boost the international role of the euro. I mean, I think from the point of view of convincing policymakers, if one focuses on the economic benefits, I think you are going to go nowhere. So what is actually fundamental this period here, and it's a bit in line with my slides before, is to rehearse the arguments in geopolitical terms. So the issue here is if you do that, it is also a means of reinsuring, self-insurance that I think is fundamental now, that we don't have the global insurer anymore. I think in the remaining time, I think what we are stirring in at now, I think is a yawning up politically between a state of necessity, which would call for more Europe. I mean, objectively, if you list the various issues from defense, from the economy and diplomacy and all the rest, and the actual feasibility. Between economic necessity and political feasibility, I think there is a yawning gap, which we would need, I think, to tackle. I'm not over optimistic about that, given the political configurations that we have in Europe, but nonetheless, I think making the arguments that you can be a sovereignist, it doesn't exist in English, okay? But do it at the European level, not at the national level. I think in terms of the risk, and maybe I finish with this, one will have to reassess a bit, several trade-offs. A key one is between, let's say, innovation and risk. We are now, I think, after the global financial crisis, we have given, and I think rightly so, primacy to stability in order not to repeat the same. At the same time, we know that radical innovation cannot be, you cannot pursue radical innovation if you stay within the corridor set, ex ante. And us, we are the children of ordoliberalism. So what we do in Europe, I mean, we set the corridor and then let the markets and innovators operate within that corridor. In the US, they do the opposite. There is no corridor. You operate freely, and then hopefully they can say, okay, we curtail the excesses ex post. I think that's an illusion, because whilst you are actually letting the markets free, you create the vested interest not to correct the excesses ex post. So here we will need to find, I think, the right middle, so a third way between our classic ordoliberal frame of mind set in the corridor and the illusion of the US of correcting ex post. I think it's a big endeavor, but I think we should embrace it in earnest.
That's what we are trying to do at the ECB, maintaining the legacy of the Bundesbank of ordoliberalism and having embarked on a more activist road like the Fed in the past 15 years or so. Next, I would like to turn to Ian, please. And I would like to especially hear from you, how do you see, you referred to Asia's role, so do you see that Europe and Asia could jointly, in cooperation, say, save multilateral international cooperation? I'm asking this today, which happens to be not only the birth date of President Urho Kekkonen in Finland, but also the day when President Xi is holding a major military parade in Beijing, joined by President Putin and Kim Jong-il. Please.
Yes, I think Europe has a big strategic decision to make on this. My view is that we need to find common ground on everything we can find common ground. There are many things, not least on climate change, on stopping pandemics, on global financial stability, where I think we would be able to find common ground. There are some things, like military, where we won't, possibly. But there are many things, and we shouldn't allow the things that will prevent that common ground from stopping much deeper cooperation. It is also going to be essential, given the growing share of Asia in the world economy, in trade, and so on, that's where we understand that's where the future market is. It's also the likely source of returns on investment and investors. So there are many reasons, I think, to cooperate, a very wide range of countries, and doubling down on that, I think, is essential. They get, and certainly China gets, the significance of many of these systemic risks, and I think has the interest in dealing with it. If I may take this opportunity to just pick up on some of the other questions, that what do we do about this all? I would stress that within Europe we need to focus on economic geography much more, and left behind places particularly. Why do people in left behind places not go to where the new jobs are, whether it's from East Germany to West Germany, or whether it's from the north of England or rural parts of France to where the dynamic cities are, where there's shortage of labor? And the answer increasingly is affordability, or lack of it, of housing. There's a massive focus, I think, that needs to be done within finance on more affordable housing. Clearly, it goes way beyond that. And there are a whole package of other reasons why people don't move. But until we address this economic geography question, we will have rising nationalism and populism in Europe. If you look at the mapping of AFD, it's all about geography. And if you look at the mapping of the Reform Party in the UK and its growth and all of this, it's all about geography. And the same is true of Trump support in the US. So we need to deal with the question of how we build more flexibility. Today's the slowest day for the rest of our lives. That means we need to be more flexible in the future. People need to be able to move, to reskill, to change more quickly, and they're going the opposite direction. On euro, which has been raised, the other way, of course, to deal with the appreciation question is expansion. That has many benefits, Europe's expansion, but so too does it for the euro. On productivity and growth in Europe, I think people are being a bit optimistic. AI will not lead to a growth boom anywhere, except perhaps in China, for very particular reasons, less so in the US and less so in Europe. That we need to find other sources of growth, and we need to come to terms with a future of low growth and its implications around that. I do not see anything on the horizon that will change that dynamic in significant ways. The final point to make is arising out of the nationalism and populism debate, the anti-migration sentiment is a real threat to all our societies, particularly aging societies, and is an inflationary threat in labour markets. Adam, you touched on this very briefly, but it's an issue which is going to come back to haunt us, and developing a migration bargain in which we are able to show that we can control migration, but that we embrace migration both at the top end, because they are the innovators, the skilled, they're twice as likely as native people to start new businesses and create dynamism, but also at the lower end, who's going to look after us in our care homes, in hospitality and elsewhere. Europe has a wonderful internal labour market of 300 million people, but even that is beginning to run out of steam. And in smaller economies like the UK, this is a very significant inflationary hurdle, as of course it will be in the US. So another non-economic, if one wants to put it that way, question to address is that. Thank you, Chair.
Thank you, Ian. And next it's Cornelia's turn, and you already had your homework, so, and you've done it.
I have my question already. So on crypto, unbacked crypto assets. I mean, unbacked crypto assets are a Ponzi game. It's very clear. The people, the crypto bros who have invested early, they make all the money. They benefit from promoting this. Of course, because then smaller investors will come in, and then if the bubble bursts at some point in time, it will be likely the latecomers who will have the higher losses or complete losses. And of course, it's a very, very volatile asset class. But it has been going up and up. So there's a danger that more and more people with not deep savings put their savings in there, and then they may lose everything at once. So that's a real issue. And then the question is, if there are really widespread losses across the economy, do we have to step in as central banks, as regulators, as government? Do we have to help these people if they really lose all their savings? And I think the case for that would be even stronger if banks had a really very active role in selling and promoting these currencies to the public sector. So there's an issue there. So it's a little bit a question, so how far do we want banks to be involved in this and reap the benefits of it, which are temporarily there, and this holds for stablecoins in particular, or do we say, oh no, this closeness and interlinkages between the banks and these coins, it's we would rather keep it apart a little bit in order to make sure who's in the end responsible, which is the ones who buy it, and not anyone else who has been warning about it. So stable coins is a bit a different issue. Of course, stable coins are having a peg. The peg is typically a stable currency, or it's government bonds. So So from that perspective, yeah, they are much better, much safer, much less volatile, but also they break the peg sometimes. So the largest ones, Tether and Circle, I think it has occurred for both of them at some point in time. So it's also not that this is a risk-free investment. Yeah. So yeah, well, and I think. Yeah, users or investors, they should be made aware that this is not a zero investment, zero risk investment. And also, you mentioned free banking earlier on, no? So how do I imagine a world when there are several issuers of stable coins that are circulating in parallel? Do we have exchange rates between them? Do they all trade at par? I don't know. Let's see. That will, of course, depend on how they're regulated. And yeah, whether we have also competition between, say, European and other stable coins from elsewhere in the world with a different background, regulatory background. So that's going to be really important. So at the same time, I think we should, I mean, the technology is out there. I think Europe shouldn't just watch others do it. I think we also need European stablecoins, and this goes, I think, back to what Adam also said. So Europe has to act as well. We cannot always shield ourselves in the way that you said, Marco. No, we are always taking this risk. Oh, there's a risk. Let's try to kill it in some way. That's the typical European approach. No, they're out there. They will grow. So let's make sure that we also have some European stablecoins that can reap some of the benefits and keep that here in Europe. We do have a strong regulation. I think MiCAR is a very good regulation. But the issue really arises, and this is what President Lagarde said this morning with these multi-issuance stablecoins, that issue in different jurisdictions that are subject to different regulations, and the problem can arise if there's a run on that and those group of coins that then European assets will be used for that. So that's the real danger, and I really hope that the European regulators will take a very close look at this and close this gap. So I think overall, innovation has benefits and risks, and we should find the right balance for that. And I think here, and also on the private markets asset aspect that I touched upon before, it's really important that we have international cooperation here. And we are at a point in time where we cannot be so sure how the international cooperation is going to work going forward, also with regard to financial regulation. So it's a big question mark, but it is important.
Thank you, Cornelia. And I'd like to turn to Loriana and ask what policies to prevent and mitigate. And perhaps you could elaborate also one issue which came to my mind when listening to you. Is it safer to have banks dominate the European financial landscape, or does a larger non-bank spectrum actually reduce risk through diversification? What's your view on that?
So thank you very much for the point. I think that on top of the question of risk, we need to bring also into the picture the question of efficiency. So I think that having this banking sector very large and having the non-bank financial institution sector very large as well, and we need also to try to understand if this is the most efficient way through which we are really, doing financial intermediation, on top of the question of where are the risks of this system. Because my impression is that there is a strong relationship between non-bank financial institutions and banks in Europe, also because banks are still dominating the financial sector, and non-bank financial institutions are able to be in touch with the retail investor only via banks that are also asking a significant fees for this. So I think that on this side, we can continue to discuss quite a lot, that there are not only risks, there is also a problem of efficiency. On the other side, I do appreciate the fact that we are all talking about the fact that we need to find a common ground, that we need to have international agreement and regulation. But I think we need to start also inside Europe. So the situation that we have in Europe is that most of these institutions are concentrated in few countries, largely two, and the supervision, it is clearly delegated to these different countries. So we don't have enough, let's say, sharing of what is going on and in this non-bank financial institution, not only because we don't collect the data, but also because there is not enough sharing of this information. And on the other side, I think we have also another issue, that is we don't have a unified supervisory mechanism. We do have common regulation in terms of supervision and regulation, but we know that each country in Europe are then implementing this regulation in their own way. So we are all talking about international cooperation and so on. So let's try to do something also here. We have all these challenges that are coming from abroad. We need to improve our, let's say, market. If you want to talk about a European market, a European financial system, we need to try to eliminate all this type of friction that so far we have, on top of clearly having the euro more important and a safe asset maybe in Europe. So I think that these are the different aspects that we need to consider. They're not new, but we're not doing it.
Thank you, Loriana. Now I would like to ask if the panelists would like to make some brief comments on the other panelists' interventions. You have a chance for that at this stage.
We all agree.
Very good. Very good. I would have actually a set of questions here, but I would prefer to have a dialogue, and as we have a very not only distinguished but knowledgeable and experienced audience, so I would like to open the floor for questions now. And when you pose a question, please remember to state who you are and preferably also where you come from, functionally or geographically, and then pose your question. Please.
You have to wait for the mic, because we're online.
Thank you. Federico Cornelli, Commissioner at CONSOB, Italian Financial Market Authority. We see a problem in the crypto, another one, which is that nobody in Europe stated that it should not have any legal tender. And in the Italian civil code, people can exchange freely whatever they want, but we forget in MiCA to explicitly say that crypto asset, even those having an underlying, do not have any legal tender. And the second problem that we see is that growing the amount of crypto, one day we might have not a bank run, but a crypto run. And then that day people may discover that the reserves are in Salvador or in some very far country. And we are afraid that, again, as we have used in the past, then someone on the political arena would ask for public money to stabilize it. The poor, let's say, the poor crypto investors, because they see a political dividendum at next election. Thank you.
Thank you. Would Cornelia want to comment?
I don't know what to answer, because I agree. No, these are risks. I think they are there. I don't know about this aspect about how legal tender is framed in the regulation. I mean, but it's of course something that can be said more explicitly. The question is whether the investors will care, no? Because crypto, it's like an investment. I mean, people don't pay with crypto. We may pay with stable coins at some point in time, but not with the unbacked crypto assets. I think for all the years that it has been out there, it has only been used for the black market, no, on the dark web and so on, but not so much for normal business. So I doubt that the business case for that is very strong. But I think it's good to stress that. And I mean, of course, legal tender coming from the ECB, I can now see, of course, we are working on the digital euro, no? That would be legal tender, and that would be a benefit, one of the benefits of that.
Please, in the front row.
Thank you very much. Abdelaziz Rouaba from Central Bank of Luxembourg. and I am interested in these 4 quadrants by Mario, and as you can expect, I am interested in the last one. Because you said that according to you, the last quadrant is likely. What is the level of the probability of materialization of such quadrant in which the US dominance economically and also from a weaponization point of view? In such scenario, I have a question for you. Which policy might be adopted rapidly in Europe in order to minimize consequences of such dominance of the US on Europe? And according, you made reference to your model. How was the weight of taking into consideration Shanghai Cooperation Organization and also the BRICS in this new world? Thank you very much.
Thank you. Marco, the question is directly to you, so please.
Okay, no, thank you very much. My slide violated the Einstein principles that one should build a model, as simple as possible, but not simpler. So I think my slide is a bit simpler. Nonetheless, I think is, the last quadrant, and that I said, would be probably, I think it would be safe to take it as a central scenario to, looking forward. I have that in mind also, thinking about the recent negotiations on tariffs with the US. A typical bias that we have as European, we always negotiate having in mind a positive sum scenario. That it's in part because it is in our DNA. That's what we integrate for that we contribute to multilateralism, and we like that for that reason, but also because it makes things easier. So if you take a central scenario, which is a positive one, I think we should, from now on, escape that bias and look at I think the realities in the eye. Now, I think that quadrant there, in a sense, where you have no free trade and no free capital mobility. I think from a macroeconomic viewpoint, actually from an accounting viewpoint, if there is an increasing obsession with bilateral trade deficits, the counterparts of that is capital movements. So, you would almost inevitably end up in something which with lower capital movements. So the second point, more importantly, is the fact that we see it, right, on a daily basis, weaponization of everything. That's what was the underlying in that quadrant. So also from the point of view of currency, capital, mobility, financial flows. So I think inevitably we would be entering into a situation where capital mobility will eventually be hampered as well. Now, I think a way out of that is not to try to, because I think it would be a bit foolish, to go back to the classic multilateralism, but I think Europe can take the initiative and rebuild multilateralism bottom up. So I think we have, and I agree very much again with Adam, we have a model to propose to the world which is much more attractive than what China on the one hand and the US on the other hand can offer to the world. So I think here we are, I think the Commission is started to do the right thing, I think on Mercosur, on other advanced economies, Canada in particular, we have Mexico, Switzerland, I think we have progress in negotiation within Indonesia. We have in here, a big point which is very much related to what I think Olli said at the very beginning. I mean, India, we opened up, I think, there a line of cooperation which is potentially promising. Now, whether India is swamped within the Chinese-Russia world, then I think it's a very, very big question. But I think rebuilding multilateralism bottom up, I think is important. But here there is a link also. I make my final point on this. There is a link between the credibility of offering to the global South an alternative model to what we are doing actually now with the vis-a-vis the US and vis-a-vis also digital. I think if we do not fend off the attack that is now even more dangerous for our democratic texture and our democratic fabric on the digital side, and we do not stand up to that, I think the credibility of proposing to the world a different model will be severely hampered. So I think there will be in the next months, weeks, and probably even days, a very important checkpoint on whether what we propose to the rest of the world would materialize or not.
Thank you, Marco. Very important policy program for the coming months for Europe, slightly beyond the ECB, ESRB remit, but important nevertheless. Francesco, please.
Thank you very much, Francesco Mazzaferro, here from the Secretariat of the ESRB. I was very interested by what you say, Professor Goldin, about the need of finding an equilibrium of where to trust and where not to trust with China, fundamentally. And I wanted to ask you, do you have historically any idea of a system which was stable in which the people were lending money to the enemy? Because at the very end, this is of course, historically it happened, no? The figure during, in the past, they were lending to everybody. So it's because these were private contracts, and if you were lending to Charles V, so the enemy of Charles V, what was important is you received the money back. At the very end, they defaulted, of course, because to do it in war is difficult. But is there any precedent case in which you would see it's possible to do even a new monetary order or these type of things with regimes which at the very end politically are adversarial, to say the least? Thank you.
Yeah, that's a fascinating question. I mean, one might say that we're seeing in real time in the relationship between countries and the US this playing out. It's becoming extremely adversarial to countries that it has very deep financial relationship, not least the US and China, and the Chinese holding of US treasuries, for example, but many other countries too. But I would question your hypothesis that China's an enemy. I don't think it is. I think China's success over the last 45 years has been entirely based on an embrace of globalization and many of the principles which we would advocate. China would not have doubled its income every 10 years since 1990, slowed down recently to only 5%, which would be lovely for Europe to have. But this is based on integration in the world economy. And I think China gets that it needs globalization just as much, if not more than globalization needs it. I think it gets that very deeply, and that the whole reason why we're seeing the Belt and Road Initiative and many other things being manifest in economic terms is because it needs that integration. And will increasingly do so as it moves to a high-cost economy. The labor force of China is 4 million less people this year than last year. Real wages will double over the next 10 years. And so it gets that it needs to transform and integrate even more deeply. So I think it has a material interest in integration. The second thing is that it certainly has a material integration in, if not multilateralism, minilateralism. It's proved itself very vulnerable to the pandemic. Climate change is probably the most fragile country on Earth and the most vulnerable country on Earth. And it gets that, and it gets the importance of financial stability and many other things. I think we need to focus as Europe on what is it that we can work with other players wherever they are in a minilateralist sense, building coalitions around the things that are systemically important. And on many things, including climate, by the way, where something like a dozen emitters account for 80% of emissions, we don't need global cooperation. The Bretton Woods, the UN system was built on that everyone has to participate. That's not the case for most problem solving. The only one it's the case for is pandemics. It's the only risk that we face that can come from absolutely anywhere on Earth. The poorest country or the richest lab in the richest country. It's the only one we need global cooperation for. Every other risk, a handful of players can deal with a big part of the problem. And those players increasingly aren't even federal governments. If we cooperate with California, with New York State, and with others on climate, we can make a lot of progress on that too, as well as big corporates and cities. So I think the idea that we have adversarial countries that don't have mutual interests is slightly idea of the past because of our entangled future. We are deeply entangled on all dimensions through systemic risk, and that means we have systemic reasons to cooperate, which may not have existed in the same way in the past.
Thank you. Any other questions from the audience? One for the road, probably, please.
Thank you very much. Javier Suarez, FEMFI, also Advisory Scientific Committee of the ESRB. I'm going to not touch on geopolitics, but on the remarks regarding market funding by Cornelia and by Loriana. I wonder whether in a context like this, we are providing the right messages. In terms of economists always like to stress the existence of trade-offs. So what are the trade-offs involved in the development or deepening of this savings and investment union vis-a-vis the threats from non-bank financial intermediaries? So I think in a matter of a few hours, we see both. No? We sell the idea that we need a bigger or a fully developed savings and investment union, and at the same time we tend to describe non-bank financial intermediaries growth as a threat. So where do we stand on this? Loriana was showing that non-bank financial intermediation, according to some measure, I guess is total assets under management, has taken over the US in terms of importance relative to GDP. My guess, probably confirmed by your analysis, is that this is mostly because Europe, in its financially integrated globally role, is the asset manager of many foreign investors. But this doesn't mean that they are channeling these funds towards European non-financial corporations and households, where I think banking is dominant. So I guess that when we are saying we should develop the savings and investment union, we are saying more than a more developed asset management sector in Europe, what we need is more developed primary markets where the funding from non-banks can reach households and firms. So maybe I would like you two to elaborate on what would we need for that and whether that involves threats to financial stability. I think Cornelia was clear in the description of private equity and private credit as an opportunity, but at the same time, maybe less stable than banks. I'm not sure we fully understand to which extent private equity and private debt markets will be dominant, and in particular, in which context to banks in terms of financial stability and economic performance in general. Sorry for this big elaboration. Thank you so much.
Thank you. Maybe brief comments from Cornelia and Loriana.
So I don't see the contradiction. I mean, savings and investment union, of course, one goal is to have a deeper, more liquid, European-wide market, financial market that includes also private markets that I touched upon earlier. I think they are needed. They have their reason for being. They are a good complement to what we can have on the banking side. And again, I would like to stress the European. It's important to have the European aspect here. But at the same time, doesn't mean they should be unregulated. I mean, banks are heavily, heavily regulated. We know that a lot of the activities that traditionally went to banks, one reason is why they moved to the non-bank sector is because it's much less regulated. It's cheaper to provide the financing. So I would plead that we have some better regulation. The very first step, and also to answer you, what are the risks that are really there? The first step is that we need to understand these risks better. And for that, we need data. And we have a very, very bad data situation in Europe, and I guess also elsewhere in the world. So it's really hard for us to understand where does the liquidity flow, or may stop flowing at some point in time, or maybe be rolled back. So that's what I would plead. I mean, now we are in a situation where everyone talks about simplifying rules and maybe simplifying regulation and so on. But I would argue that on the non-bank side, we are not there yet. We are at a point in time when we would like to actually know more. And one part of this is exchanging information across the different European and national bodies, so we understand this better.
Thank you, Cornelia. Loriana, please.
Yeah, so I do agree about this tension. I think in some sense I was also trying to stress the fact that we have all this collection of savings that needs to be invested somewhere, but we don't have, on the other side, the market that will allow us to reach all these retail investor or small and medium enterprise. And, the solution can be, on one side, used maybe for retail investor more covered bonds, where pension funds and insurances and so on can indeed provide the funding still through the banks, but in a way that will take out part of the needs for funding by the banks. On the other side, I know that we are still having the crisis in mind, is to do securitization as the US are doing. So if we want really that the money are going to this type of let's say a small investor, you need to go through financial assets. So you need to securitize or create some other type of financial asset that will allow the link between this non-bank financial institution, like insurance, pension funds. I'm not talking just about private credit that are going clearly to fund what they can fund. Having the capacity they have to screen and so on. So there are different aspects that need to be combined in order to have that the money. It's not enough to have the money. You need to have also the instrument and the infrastructure, and that will help to go on that direction. So that's why it's not enough that we are, claiming that we want or we are stressed about this type of institution, but we need to have the right infrastructure that so far we don't have. The good thing is that if you're thinking to the non-bank financial institution, they do not have cross-border limitation as banks do have.
Thank you. Thank you, Loriana. And thank you, Ian. Ian has to go to another meeting within this building in the top floors. So the only thing in between the lunch and the moment is the conclusions. We don't unfortunately have more time for questions. So I would like to warmly thank our panelists for their insightful interventions and the audience for very pertinent questions and discussion. And I would say we have 4 takeaways from this discussion. Four clear messages stand out, including also the earlier part of this morning. And the first is that geopolitics is today exceptionally strongly dominating the world economy. The regime shift in the United States seems, if not permanent, but nevertheless long-lasting and persistent, and we are thus in a world of new economic geography, as Adam Posen put it. And this means that also the global geo-economic landscape is shifting very fast. The US is reshaping trade and capital flows in ways that could entrench fragmentation and generate new systemic risks for Europe. And one important takeaway from this panel is that I'm referring to what Marco said, or paraphrasing Marco, that we have to rehearse arguments in geopolitical terms, which in the European Union means the necessity to finance common defense as a European public good, which is also a significant avenue for introducing European safe assets and thus work towards deep and liquid capital markets in Europe, which we are currently still lacking. Un coup de soissons, as the French say. Second, referring to Ian's intervention, non-economic risks are now central to financial stability. Climate shocks, pandemics, governance gaps, geopolitical tensions, all these feed into systemic vulnerabilities, while at the same time international cooperation is in very weak oxygen, and has been weakening. And third, referring to what both Cornelia and Loriana have intervened today, the growth of private markets brings both opportunities and risks. That's part and parcel of the Savings and Investment Union in Europe, which we are aiming at. They can boost productivity, but they also concentrate exposures and often remain opaque. Better data and closer monitoring are essential, and that's, for instance, what we proposed in the recent ESRB review. And fourth and finally, crypto assets and stablecoins, they are, at least in the United States, they are moving into the mainstream. Their growing links and interconnections with the regular and regulated banking system and the rest of the financial system, and the dominance of the USD-denominated tokens, these carry risks for European financial stability and even monetary sovereignty. So in short, systemic risks are more complex, more global, and more interconnected than ever. And a key task for the European Systemic Risk Board in the next decade is to reinforce foresight, close data gaps, and ensure that the European financial system maintains its current resilience. And in the grand scheme of things, finally for Europe, we should be proud and stand behind our European model of society, democracy, and the rule of law. Reform it, yes, but stand behind our rule of law and societal model. We should play our own game while combining it with concrete and urgent actions how to become a serious geopolitical actor. In brief, I think that's our policy agenda going forward. So I thank you all very much, and I wish you an enjoyable rest of the day.